righty now. Thank you everyone for joining us. If you are watching the live, go ahead and hashtag live. If you are watching the replay, hashtag replay. I want to welcome everyone to S.M.E Talks, where we have the opportunity to talk to experts in the real estate industry, whether they're mortgage lenders, officers, realtors, agents, you name it, all across the board. We want to talk to the individuals that are in the game, really tackling it and doing things day by day, servicing the community to the best of their ability. So today I have the pleasure to welcome Jose to the show. He brings a wealth of knowledge in the mortgage industry. We got a little bit of time to talk beforehand, just to do some of the pleasantries, get to know each other a little bit, and yeah, I'm excited about this one, guys. So without further ado, Jose, please, my man, I'll give it to you. The floor is yours. If you can introduce yourself, and we'll go from there.
Hey Jay, thanks for the opportunity. My name is jose.sampoll. I'm with CrossCountry Mortgage. I'm a branch manager here in the Tampa area. I've been doing this now as a loan officer for about 11 years, and been in the banking industry since 2006, straight out of high school. Worked flipping fries and burgers as a teenager, and then I looked across the window from the drive-through and saw a bank, and I went and applied, and they gave me a job as a teller. They needed somebody bilingual, and then that really changed my life, just because at that point I changed my degree, chose to follow finance as my degree. So I have a finance degree from Indiana University,
Nice.
and just been involved in finance basically my entire life. Even, I served 6.5 years in the U.S. Army as well during that time, and it was somewhat finance related. So I was a human resources officer in the Army, so I was involved with a lot of the pay issues that our soldiers would have. So numbers and finance have always been in my mind. I really enjoy it, and I love the impact that it has in people's lives, not only right now, short term, but also long term. And I have a passion for that. But I'm 35, I'm married, have 2 beautiful children, originally from Puerto Rico. Grew up in Indianapolis after my father had a job transfer back in 1998. I was 11, didn't speak a lick of English. I got thrown into the middle of the Midwest, so it was definitely a culture shock.
Yeah.
A big adjustment, but thankfully I played sports in Puerto Rico, and that helped kind of make the transition over to a place where not a lot of people look like myself. Made it a little easier, because they didn't know my name. They haven't seen maybe somebody that looked like me, but at least I could hoop. So they'll pick me up, and that helped make friends. And then like I said, I went to high school there, went to college there, and then started my career there. And in 2017, me and my wife looked at each other and said, "Why are we still here? Like, we're both from warm places. Like, why are we still dealing with negative 10 degrees and being cocooned for 5-6 months a year?" And we said, "Hey, we only have one life. Let's take a chance on it. If it fails, then we can always come back." And we took a chance in 2017. Sold our house, lived in an apartment for a few months, packed a U-Haul, and we drove down here, man. And been here for 5 years as of 3 days ago.
Wow.
And so we love it here. We built a lot of great relationships, and not everybody wants to move down here with us. So
yeah,
Florida is a great place to live, and we look forward to continue to establish roots here and help as many people as we can with with the services that we provide here.
awesome, man. You know what? So with us talking prior to recording, that's one thing. And even us following each other for some time, that's one thing I did not know, man. I did not know you served in the Army for 6 years. So I appreciate your service, man. Thank you so much for
Likewise.
that. Yeah. That's so awesome, man. I did not know that. So one thing that I did want to address. So you mentioned that you changed your degree, right? You were working. You said where were you working when you seen the bank?
Yeah, so I was working at Culver's, flipping fries and burgers in the drive-thru of a fast food restaurant.
And you were attending college or high school at that school?
I was in my freshman year of college still,
Okay.
just because I had been at this restaurant for 4 years. I ride my bike, uh, back and forth. It was just convenient, and I was a full-time student, so didn't need a lot of money. And
Yeah.
I knew how to do it. It was fun, but eventually I got tired of it. And just like, man, I like to wear a suit every day or wear a nice tie. Tired
Yeah.
of smelling like French fries every day.
Yeah,
So,
man.
um,
What was your degree? What were you taking out?
yeah, so I was in the route to become a civil engineer.
Okay.
Uh, I had
Okay.
a huge passion for designing or kind of building things, and then in the Latino community, engineer is like this, like it's seen like as a doctor, right? It's always
Yes,
like
100%. Yeah.
everybody wants to be an engineer when you're Latino, it seems like,
Yeah.
especially Puerto Rican.
Yeah.
And so I wanted to be one.
You wanted to
And
build things. Yeah.
and then I realized that I was like, I don't know if I have a passion for like chemistry and biology, sciences. I have a passion
Yeah.
for numbers, but not so much sciences. And once I started working at the bank, it just clicked. I had a passion for the conversations that I would have with the clients. How every day was different. Every day brought a new challenge, and I was like, what? I'm kind of good at this. Maybe I should follow this path.
Mm.
Changed my degree and been here ever since.
So you would say that you found yourself in an advisory position and you enjoyed it pretty much.
Yeah, I think also, now that I think about it, and it was obvious back then, was growing up in Indianapolis, seeing how impactful it was for Latino families to become homeowners. I would say that a lot of us didn't know how to become a homeowner just because
Mm-hmm.
of the language barriers that we were
Mm-hmm.
facing, and just in general not being knowledgeable of the process of purchasing a home or real estate in general.
Yeah.
And so I saw an opportunity, for me to help people like my parents, right, who came into this country and just rented, right. They were like, we don't know how to purchase property, we don't know much about credit, I don't know if we're ready, et cetera, et cetera. And it was just a lack of education, right? People are just renting and renting and renting and don't know that they have great credit or that they're paying, $500 a month, more a month for renting, where they can own something of their own and pay
Yeah.
less.
Yeah.
And so I saw an opportunity for me to have an impact in the community. And also, I'm not going to be, sugarcoated, but it was an opportunity for me to be successful, right? Because I already had a niche, a market that I could kind of hold on to and not only make a living for myself, but also impact the community and change lives that way. So I think it was just, I saw an opportunity, I seeked it, and it turned out that it was really impactful in other people's lives. And, I've been able to now take that position, like a manager now, where I'm helping young loan officers have that same passion and that same drive to succeed and help others.
Yeah. No, no, I like that, man. And so when when you started in the industry, did you need to find a niche, like to say, okay, I want to help Latinos, or I want to help, families that are less fortunate, or maybe, I want to start off educating, individuals on, money and stuff like that. Like, what was your idea behind, okay, I want to get into banking or finances? Like,
Yeah.
kind of expand
Yeah.
on that.
So obviously, I looked myself in the mirror and I'm like, okay, this is how I look and this is how I speak. It's probably easier if I connect with the people that look like me and speak like me,
Maybe.
right?
Yeah.
So that's mostly what I focus on. And at the same time, I think my employer saw it that way as well, right? So at the time, I was working for Chase Bank, and I was the only Spanish
Mm,
speaking loan officer in the metropolitan Indianapolis area.
wow. Yeah.
And they said, hey, listen, we have these pockets of the city that are Hispanic driven, or we have a large population of Hispanic customers that walk into that branch every day. We're going to give you these branches. These are yours. And for you to be there maybe once a week at one of the branches and work with the tellers and the bankers to, help the Latino community. And that was great, but man, it was tough. It was really tough because people didn't know. They just didn't know. They
Mhm.
were scared to buy a house. I mean, they thought that something could happen to them if they apply for credit. I
Apply.
mean, you
Yeah.
name it, right? Or they
Yeah.
don't believe in the banking industry. They're like, oh, I have all my money at home, maybe whatever their reason. So it was tough. It was lower income areas. So I always, when people ask me today, one of the key things that I would say that led to my success or to where I am now is those branches in the lower income family areas, because I want to say I didn't have to get creative, but I had to deal with a lot of tough situations. Be patient. Hey, your credit's not there yet, but we're going to work towards getting it there. Because why? People, shoot, you didn't know how to get it there. You had no idea that taking out a credit card will actually help you. You had this
Right. Yeah.
giant fear of, well, I'm going to get a credit card and it's going to ruin my life. No, like, you get a credit card, you keep a low balance, your credit will increase. Now you get another one, or you become an authorized user in your father's account, and that builds credit for you.
So correct. Yeah.
Just a lot of education, a lot of first-time home buyer seminars, a lot of visit to community centers, just teaching about home ownership and financial literacy. So that was my main focus when I first started. It's just focusing on the Latino community, because there was just a lack of assistance towards them, and the low to moderate income families. So one of the roles I had in my early career was CRA, so Community Reinvestment Act loan officer. And it was specifically focusing on low to moderate income families. And we had some custom programs where we had like no money down, low credits, low interest rates. But it's because the government was indicating to us, like, listen, these communities are not being lended on. Like, they're basically what's called redlining. It almost seems like, banks are just putting an X on this community or the hood and not wanting to help out. So you go out there and you try to initiate those initiatives, the mortgage initiatives in those communities, and start originating in those communities. And so, I come from a background of, $50,000 loans, $40,000 loans, $60,000 loans, while my colleagues, 20 minutes north are closing $300,000 homes, and they're making 4 times as much as me, and I'm closing twice as much business as them.
Twice as much. Yeah.
So, but it built character. It built an opportunity for me to see every customer as a real person, not just a dollar sign. So I thank God that I was in that position where I was in those rough areas that allow me to kind of enhance my skills and become a better person and a better loan officer in general.
Yeah. No, so that's a good point. Do you think it's still something that new loan officers coming into the industry, is that something that they should consider doing? Going out to the community, educating individuals, on the processes, not just in buying a home, but also on money, right? The psychology of money, how it works. Do you
Yeah,
think that's still a
100%.
practical thing now?
Yeah, 100%. Obviously, there's other ways to do it now with the technology that we have. Maybe you don't have to physically go, to those places. Now you can do some of the things that we're doing, right? Where we can share these things, and hundreds or thousands of people can see these things without you having to physically take time away from your family at 6 p.m. and go to the X community center, and then 5 people show up. Now, you can take different ways to educate, but absolutely, because not a lot of people are doing it, right? So when you see an opportunity, you seek that opportunity, and you feel a need, you can have really, a lot of success. And also, when you help people like that who maybe haven't been educated before, who haven't been taken serious, those are customers for life. Those are customers who really value you and will continue to send you clients, and they'll be forever grateful to you. Where a lot of times, if you try to be one of the loan officers or realtors who just does what everybody else is doing, it's harder to stick out.
Yeah.
Right. So I think in this industry, for anybody who's a loan officer or realtor or any salesperson who's out there, I think one of the big things you want to focus on is, how do I stick out from above the rest? That's a key thing in sales, is what do I do different that allows me to shine?
Nice.
And when you can shine by helping others, man, like your career will just take off, just because people being thankful will multiply your business by 2 or 3 times, just by hey man, you're the first person to actually take the time to educate me on credit. The last five guys just hung up on me or didn't take me serious, didn't call me
Right.
back, or whatever
You,
the
you,
case
you
may
didn't
be.
qualify. Click.
Yeah, bye. You didn't qualify.
Yeah.
Come in when you qualify.
Right.
When
Yeah.
all it took was maybe, hey, listen, like add yourself to a credit card, lower the balance on this one, and you'll get 40, 50 points, and now you'll be eligible to buy a home.
Yeah. Yeah.
And so, absolutely, if you're somebody who's in any sales environment or anything, definitely helping others and investing into your community, it's a way to go for sure.
Way to go. Yeah. And I was going to ask you that too. If how do you see yourself, being able to market yourself different from, the competition, if you will, but you pretty much you nailed it in terms of, what you're doing, how you've done it, who you've reached out to, how you've educated them. So
Yeah,
that's good, man. And I think we need more of that versus just a sale. It's like, let me educate you, and I heard something recently that it was, I'll educate you, but unless I educate you, you're gonna have that hesitancy, right? But it's a two-way street. It's like I can educate you, but it still makes it, your responsibility to execute, right? So
100%.
it goes together. And that's how I look at it, as a realtor standpoint, is that I'm gonna educate you on, the industry, on, things that you have told me, from the questions I've asked. Um, but then it's also your duty to execute on everything that, we need to do to make sure that we can get this purchase, we can,
Yeah.
close on this transaction. So
No, I tell my employees all the time, you cannot want this house more than your own client, right?
yeah, yeah,
So what was the old saying? You can lead a horse to water, you can't make him drink,
yes,
right? It's
yes,
like we're here as educators, financial literacy educators sometimes, but you got to want this, right? You got to be committed,
yeah,
to the success of this transaction, right? If
right,
you if you're not committed to it, then there's only so much we can do for you.
yeah, yeah,
And
100%.
then, when what you mentioned about marketing, moving to Florida for me was another kind of big shock, just because I didn't know a single person here. I didn't have high school buddies. I didn't have anything. I didn't have family here. So, I stayed around for 6, 7 months. I just looked around the market and just realized that, okay, we have MacDill Air Force Base here. We have
Mhm.
bases in Jacksonville. We have bases in Pensacola, Fort Eglin in Navarre, Homestead. I mean, we're everywhere in Florida, and I saw a huge need for military lending or military education. And from my
Yep,
background, I just said, listen, this is the perfect situation for me to help educate about the greatness of the VA loan. And
nice.
so I started just kind of like pushing it, like, listen, VA loans are great. Like we're not broke just because we're veterans or we're looking to buy a house for zero money down doesn't mean we don't have money. So,
Yeah,
take us
yeah,
seriously. And that really, I think, was one of the things that opened the door for me here locally in the Tampa Bay area, which is becoming an expert or an advisor when it comes to VA lending or VA loans in general.
yeah. That's
Because
awesome,
I
man.
mean, to this day, I mean, and I think we're seeing it more than ever in this market. Veterans are having a tough time
Hmm.
finding a house, and I mean, I would like to say that 90% of the time is lack of experience and lack of education from the other side of the transaction, right? A realtor might say, well, VA loans are not good. This is not a good offer. State the conventional offer. Well, Lito, did you know that that veteran has an 800 credit score, got $100,000 in the bank, and has a debt to
Yeah.
income ratio of 20%? And the offer you're taking, if he breathes too hard, he might not qualify.
Yeah.
But because he's using conventional, that's a better offer.
That's better offer. Yeah.
And it's
Better offer for who though? Like,
right. A
yeah.
lot of times is a realtor had obviously VA loans are a lot less common than a traditional FHA or conventional, right? So, they like to say the 1%, right? Veterans are the 1%, right? So that means that there's a lot less VA loans happening versus
Yep.
other loans. So if you're a realtor, you probably have a lot less experience on VA loans just simply because they're done less. And if that one loan that you did 2 years ago went south, you have this sour taste in your mouth of like, man, VA loans are bad.
Yeah.
I don't want to do VA loans, right? And it causes you to have this mindset of you thinking that, well, I had a bad experience with a VA loan back in the day. They're all bad.
Yeah.
And for somebody like myself who does a lot of VA loans, I can vouch like, listen, it's a complete opposite. You know, we have a lot better experience. We can close, VA loans quicker than sometimes than we can on a conventional loan. So I just saw an opportunity to again educate and help, and that's kind of how I built my niche here locally in Tampa. I was just focusing on the VA loans.
Nice, nice. Um, so what would you say? Well, let's look at, what programs you offer, not just for veterans, but as a whole. What are the programs that you offer?
Yeah, so we are similar to a lot of the mortgage companies that we offer FHA, conventional,
Hmm.
USDA, and VA. Those are probably the top four common loans, right? This is traditional government-backed loans: conventional, FHA, USDA, and VA. VA
Yeah.
for veterans, right? 0% down. USDA is typically for rural areas where a customer can go into a website and search areas that are USDA eligible. That program does have income limits, credit requirements, loan size requirements, but you can potentially buy a home with no money, no down payment requirement there,
Down payment. Yeah, yeah.
right? So VA, USDA are kind of the two loan programs that off the top don't have a down payment requirement typically.
Hmm.
Then you have FHA, which is 3.5% down, and then you have conventional, which is can start off with as little as 3% down. Obviously, all these programs could be done with zero down if there's some sort of government assistance that
Okay.
could be attached to it. But traditionally, just the standard conventional loans, 3% down minimum. FHA is
And
three and a half.
that's for, sorry to interrupt, but that's for anyone. I just want to make sure that, we may have individuals that have no clue
Yeah.
about how this works, but so just so that we're clear, that 3% is across the board. Doesn't matter who you are, where you're from,
Yep.
or does it, or does it?
Yeah, so the 3% down conventional program does have some requirements. Typically, you either have to be a first-time home buyer or you have to make below a minimum amount of income as a family, right?
Okay.
Typically, it's about 80% of the median income for the area. And so we have our website, or the client can even go into it and search, okay, what is the income limit for the area that I want to buy
Oh
in?
man, that's so good. People need that, man. Yeah, that's
Yeah, so
awesome.
they can go in there and say, okay, we make above this, so we got to prepare ourselves for 5% instead of 3% now, because we're not first-time home buyer. We've already owned a home the last 3 years, so we're not considered first time. So we know we're going to have to go with 5%. Obviously, FHA is also 3.5%, and pretty much anybody can use an FHA loan. But a lot of times, as buyers, we try to avoid an FHA loan because of the stigma that it has in the market,
Hmm.
where a seller ranks a conventional loan offer higher than an FHA offer. Typically, that's because FHA has stricter guidelines when it comes to the appraisal of a home.
Hmm.
It could be that a seller would have to repair things for the transaction to close on an FHA loan. And so, as a seller, you see a conventional loan offer more attractive simply because more often than not, the chances of it causing you to repair things are smaller when doing a conventional loan versus an FHA offer. So,
Mm.
but an FHA loan is straight a great loan program. It doesn't mean that you're some sort of lower tier buyer because there's time where somebody has outstanding credit, great income, but we still choose to go FHA because now maybe they qualify for more house, right? FHA often offers a little bit of a lower interest rate. So whenever I'm looking at a client and deciding what is the best loan program for them, it's all about listening. So I try to listen to my clients and say, hey, what is your max payment that you want to pay a month? Okay, Jose, my max payment is $2,100. Okay, how do we get there?
Hmm.
How do we get there where the budget of a home that you're looking at also matches that, right? Because a lot of times customers tell me, well, I don't want to pay more than $1,200 or something, but they have a $500,000 budget taste.
Mm.
So it's like,
Yeah.
how do we
How do we
it's all about listening. Okay, hey, my
calculate
max
that? Yeah.
payment is this. I have this much in the bank. My credit is this. I have student loans that are amount to this. Uh, and that's how we come to the best decision on what is the best loan program for a client. We as lenders, I do not make more typically if I give you this loan versus this loan, right? So our income is typically not affected by the loan program that we give you, right? So it's all about finding the best fit for your specific financial profile. Maybe your credit is 625. okay, if we go 625, it's probably better that we go with an FHA loan because it's a little more flexible, when it comes to its credit standards.
Sure.
Or maybe you have X amount of student loans, and we know that a conventional loan might be a little more flexible when it comes to the calculation of your student loans payment versus an FHA loan. So now we want to go conventional. Maybe that means that we have to raise your credit score an extra 30 points to make conventional an attractive option for you, because that's how we can get you qualified for more house, because the student loans are now, the payment on the student loans is lower, right? So a lot of times FHA will say, based on the guidelines that we have now, if somebody has student loans, say, Jose, well, I'm not making payments right now on my student loans. They're in forbearance, they're deferred. Fortunately, eventually you're going to have to pay those student loans.
You have to pay that, yeah.
Right. So we have to count something. And typically, it used to be 1% on an FHA loan. Now they've lowered it to 0.5%. But on a conventional loan, there's times when we don't have to count any payment. If you show proof to us that your servicer, it puts you on an income-based repayment program, or right now your payment truly is zero, then we count zero as your payment.
Zero, yeah.
We can't do that on an FHA loan typically. So that's where I would say, hey, John, your credit is 625. And so normally that means an FHA loan, but your student loans are going to kill you from qualifying. Let's work on getting your credit score 30 points higher. We can go conventional, and now you qualify for more because we can use a zero payment versus $250 for your student loans. And now you can qualify for that house that you wanted. So it's a really, that's one of the things I love about this industry, is that every day is a new challenge. And it's almost like a tailor, like when you're making a suit, right? You're customizing that suit for that specific person. So whenever we see a credit report or application, we're customizing the situation for that specific client. So there's times the clients come to me, hey, Jose, what's your rate today? We don't have a rate. We don't have a flat rate that everybody gets.
Flat rate, yep.
It's depending on your credit score, your income, how much money you want to put down, et cetera. So every situation is customized for every client.
Yeah. And I say that's the same concept that I apply as a realtor to my clients. They're always looking at, what is your rate to sell? And I'm like, well, let me look at your home first. Let's see what we can do. I never like to just give off numbers, because that almost will automatically give them the answer in a sense that they want. They almost don't want to do something, right? They're just looking for the way of saying, all right, I knew I was right, but you don't see the whole picture. Like, you're not looking at all the numbers.
Well, even education. I mean, you look at, they don't know what they don't know, right? So somebody, in our case, I tell them, hey, your interest rate is this. Oh, that's high. Thank you. Have a good day.
Right.
And you go with somebody else who offers you a lower rate. But little did you know that you paid an extra $2,000 for that rate, and you would have paid an extra $10 a month with me, but you would have saved $2,000.
$2,000.
So it's like you spent $2,000 to save $10, but because you were so obsessed with the interest rate, you were blinded and didn't realize that, oh crap, I'm paying way more long term for this interest rate than I could have got with Jose, who told me, he gave me the answer. What's your rate? Okay, I gave you the answer, but
exactly. They don't see the whole picture. And there's not a lot of education to back that up. So so kind of a two-part question. So the first one is, what is the ideal credit score? Not necessarily the report in its entirety, but the report, or the score that you see, and you're like, what, if you have at least this, then you could essentially apply for everything, or you could, and you'll be approved.
Yeah. So there's different levels of minimum credit scores for all loan programs. Excuse me. But I like to tell my clients, 640 puts you in a position where you can I can go USDA if the home is in this area. I could go conventional. It might be expensive, but I still that's an option. I could definitely go FHA. If I'm a veteran, I definitely can go VA. So it opens the spectrum. I think 640 is really where it opens the spectrum, because at 620, something might be kind of X'd out for you. At 580, You might go FHA, can go conventional, can go USDA most likely. So 640 is really the spot that I'd say, hey, doors are open, multiple doors are open for you. Where anything below that, you're kind of closing some doors and you're cocooning, or kind of hindering yourself from getting there. Not to mention, to be realistic, a lot of us lenders have different price breaks when it comes to the interest rate that you can get, and often the interest rate that you can get with a 625, it's much higher than what you could get if you were a 640. So sometimes I tell my client, listen, let's go ahead and get you that extra 12 points you need to get to 640, because it's going to save you $40 a month. And so little things like that we notice. But yeah, I think 640 is probably the number that I would say you can start off. Okay, I can go here, I can go here, I can go here, I can go here.
Nice.
Now, we work with.
Go ahead. I'm sorry. Go ahead.
No, but we work with clients in the 580 with an FHA loan. Veterans, veterans can even go lower at times.
So that was so I don't want you to get too far into that, because that was the second part. The second part is, does a credit score matter for VA, right? Does it for veterans? Like,
so
I have a lot of people that ask me that, right?
Yeah, per se on VA loans, there's not a minimum score because the VA it has to do a lot with like residual income. Which is how much money you have left over after taxes, utilities, expenses. You can have an 800 credit score, but if you don't meet the residual guidelines for a VA loan, you're not getting a VA loan. So the credit score, it is important because it does affect the interest rate you get, but it's not as black and white as it could be with a conventional loan, where anything below 620 it's not happening.
It's not happening.
So VA is a lot more flexible. But with that said, there's also expectations that the VA has, right? So it's like, if you have like I dealt yesterday with a client who had a 590. Okay, in theory, they meet the minimum credit score, but she had 3 late payments in the last 12 months. The VA is not going to let that fly. They like to see a clean 12 months in installment debt and things like that. So, we send up the poll to our underwriter and say, hey, listen, unfortunately, it doesn't meet the guidelines because of those 3 late payments on that car note. And so, but that is another reason why VA loans are so great, is because, if somebody has kind of a lower tier credit on a conventional loan, it's just not happening. Listen, call us back, or, let's work on this education, all these credit things to get you there. Where in a VA loan, okay, you had a little rough patch 2 years ago, and it's slowly coming back up, but you qualify. Like, even if you have a 590 or 580, you're good to go. So, that's what we also try to educate the sellers out there. Listen, like we can solve a lot of more issues with a VA loan at times than we could with a conventional loan or things like that. I think in this market, a lot of us are seeing appraisal shortages at times, like what's called appraisal gaps. And if somebody's a veteran goes and say, hey, I'm going to do 100% financing, so I'm gonna do any money down. I got 50 grand in the bank, but I just want to take advantage of the thing that I earned as a veteran. No money down, right? Okay, what if the appraisal comes in 10 grand short? That's cool. I got 50 grand. I can do it. But what if you're a conventional buyer and you were doing, the minimum was 5%, and you really don't have anything extra? Like, you're spending all your money, right?
Dang.
And now that appraisal comes in short. You don't have the ability to make that coverage, right? So it's like, if that was a VA loan, we were starting with 0 down. So the fact that it came in a little short, that's fine. Our client has the money; he can cover it. And so VA, it's a lot more flexible in pretty much all aspects, man. Credit, we can actually on a VA loan, we can go way farther when it comes to the budget that you can qualify for. Where on a conventional loan, your max debt to income ratio is 50% typically, meaning your debts plus your new house payment cannot be more than 50%. Where in a VA loan, I've done up to 75%. So, that same person, if he was not a veteran, he was going to qualify for, potentially a couple $100,000 less.
Right. Yeah.
So that's why I'm so passionate, not only because I'm a veteran, but it's just because it's such a great loan. It's so flexible for all parties involved.
Right on. And now, is that where you focus most of your time, VA loans, or is it kind of everything.
Yeah.
Yeah.
No, so that's how, like I said earlier in the conversation, how we made our bread and butter, right? We made our impact in the community, how we got our name out there as a team. But we offer anything, right? So
Anything.
we have like we mentioned earlier, the main four: FHA, USDA, conventional, and VA. But we also offer a lot of products for investors who are maybe looking to buy an investment property here in Florida because they notice that Airbnbs are great here. They have some investment properties in Georgia or Tennessee or something, but they want to buy something in Florida now. We can sometimes qualify those folks without including any of their personal income. So maybe this client has a business and he writes off a lot of his income and deductions. So he wouldn't qualify for a traditional loan. But the fact that he's purchasing this property in Clearwater and the property is going to have let's say a $3,000 mortgage payment, but it produces $4,500 a month in rental income, then we're good.
Good. Yeah.
As long as you have the means for the down payment and to cover your closing costs, then typically we can make that loan happen for you. As long as you meet a couple of the things. But we do have a lot of other programs like that one. Maybe you're a business owner, and again, you write off a lot of your expenses, but we can look at your bank statements and see all this money coming in. So we call that a bank statement loan. Might have a higher interest rate.
Gotcha. Yep.
Might have a down payment that's a little higher than normal, but that realistically could be your only option to purchasing a home, because as loan officers, we can only use on a traditional mortgage, VA, USDA, conventional FHA, we can only use your taxable income.
Gotcha.
So you can tell me, Jose, I made 200,000. When I look at your net profit, you only claim 10,000. I'm only able to use 10,000.
10,000. Yeah, I've heard that.
But in the bank statements, I might be able to use all that 200,000 because I'm counting all your deposits over the last 12 months or last 2 years. So we have a lot of tools that loan programs that allow us to help a lot of people in different walks of life, self-employed people, investors, people who are maybe looking to do a custom home, people who maybe are short in funds and need a little bit of government assistance or down payment assistance, right? They're tired of renting, but they just can't get ahead. They can't get to that number of, man, I need 15 grand to buy this house. Okay, cool. The state of Florida is offering this program. We can give you that little push that makes you a homeowner. We have those as well. We have somebody who seeing the market, maybe they are a homeowner already, and they want to do some improvements to the home to get top value. Okay, maybe we do a cash out refinance for you. When we take out some of that equity, put it in your hands, you fix your house, and now you can get top dollar for your house. Or you can use that money to purchase another property. I've had a lot of clients right now who are taking their equity on their current home, refinancing, taking that $100,000 and buying one or two different investment properties. And changing their life. And now they have passive income because now they have two investment properties that they leverage their primary residence on. And so it's a beautiful thing. And when we have all this, and this is one of the things that sets us apart from other lenders, is that we have so many different programs within our umbrella that I like to sometimes call ourselves kind of like the Costco of mortgages, just because we have all these things within our doors that we can be of assistance for you.
Yeah. I got a personal question. I got to ask this. I got to be selfish on this one. So I got a client recently asked me a question that I had to get back to him on this. And essentially he's working with another realtor that's helping him sell his home, right? So he's made some modifications. He's improved the home. And now what he's looking to do is he wants to sell that home, right? So he wants to sell that home, but he wants to pull out the equity if possible before selling it. And then he wants to purchase another home, for my case, it's land he wants to purchase, right? And then he wants to build on it. So we're going to talk about that. Yeah. But that's essentially what he wants to do. That's his idea. However, what he told me was the realtor that I'm working with has no idea whether or not I can do that. So he called me because I'm going to be on the buying side, the vacant land side.
Right.
But he asked me that question and I was like, you know what? Let me get back to you on that. Yeah. So is that possible? Have you seen that?
Yes. So there's a couple ways to handle that, right? So you mentioned he wants to buy land, right? So that, for me, that X's out what's called a bridge loan. So a bridge loan could solve your situation if he was going to buy another property right away. Because a bridge loan, For example, us, we would give you a bridge loan using the equity that you have in your current home, right? So we would give you a loan for that. Then you can use those funds to put the down payment and purchase the next one. So you're buying, let's say 500,000. Now you're putting 20% down. You got that 20% down from the equity on the other house before you even sold it, right?
Yeah.
And then once you sell it, you pay that loan off because now you have the profit. Now you can pay it off. So we can do that. Now, if you're looking to buy land or do something custom, most likely your best solution would be a home equity line of credit.
Yep.
So you would reach out to a credit union or a local institution and say, hey, I want to do a HELOC, which is basically a second mortgage, tapping into that equity, right? You get that equity, you purchase whatever you want to purchase with it. And then once you sell that property at some point, after you fix it, you whatever, then you can pay off that mortgage. You're good to go. Yeah. So it all depends on the situation, but in your situation, yeah, definitely I would say HELOC is probably the best way because they can tap into that equity right away. And a lot of times credit unions will cover your closing costs on a HELOC. And they have very favorable terms. Not to mention the payment, it's pretty cheap because it's interest only. So you're not paying principal and interest like you would on a regular mortgage. You're paying interest only. So that's something that we're pitching to a lot of our clients now who do come to us and say, hey, I want to, I have $200,000 in equity and I want to do this and that. So, okay, listen, maybe a HELOC, even though we might not make any funds from this or any compensation, we want to educate and say, hey, listen, go get a HELOC from Suncoast Credit Union or go get a HELOC from USAA or get a HELOC from wherever your institution of choice is because it gives you a lot more flexibility. And also, if this is a short term, right? So your client, this is a short term. He needs this money for a short term, so he can buy that land, and eventually he's going to pay that off. Well, that short term thing there, the HELOC gives you a low payment. So because you're paying interest only, so you have a low payment for I don't know a year while you build that dream house, and then that's it. Where if you took out maybe a regular mortgage or some sort of lending product, your payment will be principal and interest. And it could be $600-700 more per month. So there's different ways to skin a cat, as they say. But I think in your specific client, it would be a HELOC that would tap into the equity.
Yeah. There you go. See, you guys got to tap into this this podcast so you get your answers or your questions answered here. So we talked a lot about credit, right? So explain how you walk someone through, and then we gotta respect your time, my brother. So. We'll get to a couple more questions and then
Sure.
we'll if anything we'll follow up on the next one. But so walk us through your process of you have someone come to you, credit doesn't look too good, and they won't get approved for whatever type of loan it is. What is your process or your checklist, if you will, that you go through with them to say, hey, look, this is how you're going to get your next 12 points so that we can come back in 2 months and approve you to get this home or
Yep. So one of the beautiful things with my team here at CrossCountry is the fact that we can initiate a pre-approval or a loan application with a soft pull. So we don't have to do it hard. We don't have
to explain what a soft pull is for people.
Yeah. So there's typically 2 credit inquiries that we do as a mortgage officer. Well, sometimes it's just only one choice for a lot of lenders. It's a hard inquiry. Hard inquiry is it will affect your credit score. The initial hard inquiry will affect your credit score anywhere from 3 to 5 points, right? So that shows in your profile, right? So if you ever get a hold of your credit report, you can see credit inquiries for the last 120 days, right? And
who pulled them? Yeah.
Right, exactly. Who pulled them? And the more credit inquiries you have in your credit, the more desperate you seem for credit, right? And so that affects your credit score. Because if you go, let's say you go to a car dealership, unless you tell them, listen, I only want to go with Suncoast Credit Union, they're going to probably pull your credit 6 different times. And it's going to be 6 different inquiries or more, right? So you have to be cautious, and that's going to have a pretty negative impact on your credit because now you've got 6 different pools. Where on a mortgage, we do 1 credit pool, it's a hard inquiry. And it will affect you 3 to 4 points. But if you tell me, Jose, I'm not sure if my credit's there yet, or I'm not even sure if I want to buy yet. I want to figure it out. Let's start with the hard inquiry. So it has 0 effect on your credit. With a soft pool, has 0 effect on your credit. and the ones that we get, our soft pull version is almost identical to a hard inquiry. So
Okay.
we're pretty much seeing the same thing that we would see if we did a hard inquiry, which goes on your profile. And so we're able to tell people, hey, listen, soft pull, no impact, and here's what we got. Okay, you came back with a 575, and I can see that in your credit profile you have a car loan that you've been paying on time with no issues, and then you have 2 credit cards, and I can see that the limit on them is 500, and you're at a 450 balance on that. Okay, based on my knowledge of credit, which revolving credit percentage is a big impact, which means how much debt you owe against how much credit they are giving you, right? So the limit is 500 and you are already taking 450 of it. And so that's typically a negative if you are close to your limit. But if you're anywhere below 30 to 20% of that limit, it's actually helping you. That credit card, as long as you make payments on time and you keep a lower balance, it's actually going to continue to improve your credit.
It's helping you, yeah.
And so I see your profile, you have 2 credit cards, they're pretty maxed out. Then I know, hey, listen, if you get them below 20%, I know we're going to be able to get a higher credit score.
Yeah.
And then we as lenders, a lot of us have something called a rapid rescore. So we have a software that we can basically do the what if. So what if you do this? It tells us what your credit score will go to. And so a lot of times when I see a credit report that's pretty basic, just a couple credit cards, nothing too crazy, then I say, listen, I ran your scenario through the what if, and it looks like if you pay down 200 on this card, 300 on this one, and 400 on this one, you'll be at 650 versus 610 in a matter of a month.
Wow.
Let's go ahead and execute that. But if I see somebody who has, maybe there's some collection accounts, some late payments here and there, some derogatory stuff, then I usually put them in the hands of a credit expert, somebody that I trust and does just credit repair or credit advising for a living, right? So I put them in front of a true credit professional and say, this is who I trust, this is who I recommend to you, and then you can choose to work with him or her, and they might be able to maybe repair some of those issues in your credit. Maybe it was a mistake. Get them removed. Maybe it's reporting incorrectly. Maybe you don't have 2 late payments. You had 1 and it's reporting incorrectly. Or there is a lot of fair credit lending laws. That some things are if they're too old, they gotta go. And so a credit repair person might be able to help you clean that. Where me as a mortgage professional, I like to kind of like to do what I'm good at, right? I'm good at creating a loan. Back in the day, I used to, I try to act like a credit repair person, and I wasn't always giving the best advice. I'm like, let me just stick to my lane, and I'll help you with some of the basics. But once it comes to erasing things out of your credit, having to report correctly, I think you're better served working with a true credit repair professional who does that for a living. Correct. It's just like, when you're sick, you probably want to go to a doctor because they're educated and that's what they do for a living. You probably don't want to get your medical advice from the mechanic down the street, right? Maybe, his wife's a nurse and he knows a little bit, but he is not a doctor.
He's not. Yeah, absolutely. Absolutely, man. Yeah, that's good info, because I think a lot of times, we get individuals that are not in the best predicament, right? And this comes from years and years of them doing damage to their own credit, and then that resulted from that came from not having the education from their parents, right? So now it's spun into their lives, and they are where they are. So,
and sometimes it's, it could be things out of your control, right? You had a medical emergency and you were just not in a financial position, and you went through maybe a divorce, you got laid off. I mean, a lot of families dealt with this, doing the COVID, you lost your employment out of the blue. So, we're always there to try to educate you in any way that we can and teach you. But sometimes, it was just a tough situation, and hopefully we can guide you towards putting yourself back in a better position.
Absolutely, man. So you know what? So because this is our first time and we spoke quite a bit off camera. Once again, I want to respect your time. And so the last thing I want to ask you, and I'd love to have you back on here, man. I think you have a lot of information to give a lot of people. And so we need people like you, man. Seriously, I know I need you. I need that expert to go to and say, look, just like we did, yesterday with Cole. Cole, look, he's gonna take care of you, man. I asked you a
Yeah,
question, boom, you are on it. And a lot of times you are like that with anything I post on social media on Facebook. You're like, this, and that.
yeah.
Thanks, bro. Appreciate that.
No problem.
But so what is a question? I have you've seen the list of questions that I have for you,
Yeah.
but I have what is what is a question I guess that isn't regularly asked to to lenders, to loan officers, that you feel like the general public, this is a question you should be asking when you're sitting in front of a lender, or a loan officer,
Yeah.
or broker,
This,
I guess, in your sense. Yeah.
yeah. Let's see. I mean, there's one something that, I mean, this is kind of in the weeds here, but PMI, or what's called private mortgage insurance,
Hmm.
in our industry, it's kind of seen as a dirty word, or dirty thing. Like a lot of times, clients will come to me. Well, my mom said I should put 20% down because I don't want to pay PMI. Or, I went online, I saw that I need to have X amount of money down so that I don't have PMI on my mortgage. Private mortgage insurance is basically an insurance that the government kind of has put in place, where it basically protects the banks, right? So typically, if you put X amount of money, there's an insurance policy put on that mortgage where if you decide not to pay it, the bank gets a premium.
You default,
And,
yeah.
right, exactly. So the bank's not left hung out to dry, but you
Ah.
pay for that premium as the buyer. So the buyer actually pays for that insurance policy, the PMI, private mortgage
Mhm,
insurance.
mhm, mhm,
And you
mhm.
can avoid that typically if you put 20% down, or if you're a veteran, typically you don't have PMI on a VA loan. You have something called a VA funding fee, which is something that we can talk about at
Nice.
a later time.
Yeah, yeah, for sure.
But a lot of times people have this obsession, like, oh, PMI, I don't want to pay it, da 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 da. Well, did you realize that you have a 750 credit score and your PMI is $40 a month? Like, and you're over here, you wasted the last 2 years trying to save 20%, and you just keep renting. You could have bought
Renting,
last
renting.
year when you had 5% down and your PMI was only $40. Like,
Wow. Yeah.
you spend $40 at Starbucks during the week, like,
Yeah, yeah,
but
yeah.
now the house that you wanted 2 years ago is $75,000 more, and the interest rate is 1.5% higher
Yeah, you missed it.
because you were waiting for that 20%.
Right. Yeah.
So that's something that I think is missing in our industry, is um, people just hear things on the internet, or online, and just assume. Never
Hmm.
assume, right?
Hmm.
Never assume that there's no assistance for a down payment.
Yeah.
Never assume that PMI is a bad thing. Never assume that when you're buying a house you should use Geico, because Geico has your car insurance, or whoever it is. Maybe you go shop. Maybe your lender has a really good connection with a broker for insurance, and now that broker can get you, $600 less a year on your insurance. Something that you maybe didn't think about. So I think never assume. It's a big one for us, because you don't know what you don't know.
Yeah.
And we don't expect you as a home buyer to know everything about a mortgage. That's our job, to educate you and kind of lead you to the right path. So I would tell my clients, don't be afraid to ask any question. No
Right.
question is
Yeah.
silly. And please ask away, because this is your biggest investment that you probably ever make. So don't ever be afraid to ask, because
Yeah.
when you don't ask, you won't know.
Yeah. Closed mouth does not get fed, man. That's
Amen
what
to
I tell
that.
everybody. I
Amen to
tell everybody
that.
that. Ask the questions, man. Ask the questions. So, this is the big question, I guess, that a lot of people want to know in this time right now. And I promise this is the last one.
Yeah.
For someone, looking to buy, a first time buyer, doesn't know the industry well, if anything at all, is this an ideal time for them to be buying, or them to consider buying, a new home or investment property? Is this an ideal time for someone to buy?
Yeah, so I think each individual case is different, right? So as we talked about earlier in our conversation off camera, um, if you are in a situation personally where I am not going to be here or I don't want to be here in X amount of time because I have goals to move here, to move there, etc., then maybe home buying is not the best option for you right now, right?
Mhm.
Because you already have this mindset that you are moving on here. You're going to go somewhere else. So maybe that's another best option for you. But if you know you love it here, you love the beach, you love Clearwater, you love Orlando, whatever the case might be, wherever you're at, you love your area, then absolutely, I suggest home buying is an option for you. Right now, our interest rates are higher than they were 2 years ago, right? I think we got spoiled with interest rates in the 2s and the 3s over the last 2 or 3 years, and so now they're a little bit higher. But if you zoom out on the charts of interest rate, it's a cycle. Mm-hmm. So they're gonna come back down at some point, right? So if you buy a home at today's rates, you will have the opportunity to refinance that loan down the road if you desire to. And also, a lot of people think of a home as a 30-year investment. But then I asked this question: Hey, John, you want to buy a home and you're concerned about the long-term interest rate or the long-term effect of this mortgage that you're taking on. Okay, I'm looking at your history over the last 5 years, and it looks like you lived at 3 different places in those 5 years. Yeah. So why? Well, we're always looking to upgrade. My career is taken to another level, and et cetera. Okay, you clearly don't have a history of staying at a place for X amount of time. Why are you concerned over 30 years? The majority of statistics in our country nowadays say that a family doesn't last more than 6 to 8 years on a property. Wow. So why do you have this 30-year? I mean, I'm 35. I just turned 35. I don't know many people that have been in their home 30 years.
30 years, yeah.
I mean, I can't think of anybody at the top of my head. Maybe my grandparents. Yeah. But they haven't worked for 30 years. So for them, it's I don't want to say they're stuck there, but they love it. That's their custom home. But everybody in the 20s and 30s, you're probably going to upgrade or move or relocate, or the case might be. So don't always, get obsessed with this 30-year plan of, oh my God, I don't want to make this investment because it's a huge investment and I think the market's high. Don't do that. Now, the other big thing is rent. It's 100% interest. You're paying somebody else's rent, right?
True. Yeah, 100%.
So somebody else's mortgage, something that's not yours. You need permission to do anything. And so that's another big one. While you are having a fixed payment as a mortgage holder, your rent is going up 20%, 15% every year, right? So every time you renew, $200 more a month. Oh, okay, great. I can't afford to live here anymore. Now I got to find another place. At least your house, even if it goes up or down in value, this is my payment and we're good. We can afford this payment. And I think lastly, the big one that we talked about earlier was how of an effect owning a property has, not just on you individually, but it could affect many people around you, right? Your kids, now your kids go to this great school system and now they're building, relationships from the moment they're in kindergarten all the way through high school because they lived in this community when you decided to buy in that community. Typically, most people who are renting are moving from place to place. And if you have children, potentially, you are not potentially creating the stability for them, right? Okay, they went to X school for 2nd and 3rd grade. Now we're having our lease ended. Now we're going to X school for 4th and 5th. And then we're going to this school for that, where once you move into a home, that could be, a change that affects not only you, but generations down the road, because you set roots in a community and now those roots are growing and creating impact for the rest of your life.
Whew. Man, what a way to finish that, bro. That's, like I said, we need to have you back. Yeah, man, that's a lot of information I think a lot of people will appreciate and take with them moving forward. And so what I'm also going to do is I'm going to post all your information in terms of where people can find you. If they'd like to work with you, if they'd like to speak with you. And once again, man, thank you so much for your time. I appreciate you, brother. And we got some work to do, man.
All right. Well, thank you for your time. If anybody has questions, please don't hesitate to reach out to me. Message us, text, call. I'm here for you guys.
Absolutely.